Assalamualaikum warahmatullahi wabarakatuh. We are Group 7 from Section 2. We will be presenting about analysis of tax system.
My name is Noshaira Afika binti Suhaimi, metric number 1916618, and I will present about the introduction of taxes. This part will be discussing about the definition of taxes, objectives, characteristics, history, and also the comparison between zakat and tax system. What are taxes? Taxes means involuntary fees levied on individuals or corporations and enforced by a taxing authority, usually the government, whether local, regional, or national, to fund government spending and various public expenditures. Involuntary fees here means that taxes does not require consent and not directly tied to any services rendered, which is opposed to other forms of payment such as market exchanges. Next, there are a few objectives of taxes. Firstly, to influence the level of total demand in the economy. When the government wants to increase demand in the economy, it can reduce taxes, so the goods are cheaper and more goods are purchased. Secondly, to raise money to pay for government spending. Government needs money for providing different goods and services to people, such as education, medical, housing, and others. Taxation is the main source of collecting money for such purpose. Moreover, to redistribute income from the rich to the poor. When rich are taxed, this money is collected by the government and spent on services for the welfare of the general public of the country. Lastly, to discourage people from buying harmful goods, government look after the welfare of the people. Hence, many countries impose taxes to discourage people from consuming those goods which are harmful to their health, such as cigarettes and alcohol. Next, the main characteristic features of a tax. Firstly, a tax is not a fine or penalty that imposed under the powers of government. Secondly, a tax is levied to make public expenditure incurred by the government for public purposes. Next, a tax is generally payable in cash. This means that payment by checks or promissory notes or in kind is not accepted. In addition, it is source of revenue. A tax is the prime source of revenue to the government. Besides, it can also be levied on person or property within the jurisdiction of the state. There are also taxes imposed on rights, acts, or privileges, such as documentary taxes. Next, it is payable regularly and periodically as determined by taxing authority. Moreover, it is proportionate in character, which means that the payment of taxes is based on the ability to pay principal. The higher the income of the taxpayer, the bigger the amount of the tax paid. Lastly, a tax is a compulsory payment to be paid by the citizens who are liable to pay it. Hence, refusal to pay a tax is a punishable offence. The history of taxes. Paying taxes to government has been a mainstay of civilization since ancient times. The first record of organized taxation comes from Egypt around 3000 BC. Egyptian kingdom, the pharaoh would send commissioners to take 1/5 of all grain harvest as a tax. Tax practice continued to develop as Greek civilization overtook much of Europe, North Africa, and the Middle East in the centuries. The Rosetta Stone, a clay tablet discovered in 1799, was a document of new tax laws decreed by Ptolemaic dynasty in 196 BC. The kingdom of Ptolemy was a product of Alexander the Great's legendary conquest of huge swaths of territory, resulting in a melding of ancient Greek and other languages. The Rosetta Stone was therefore written in both Greek and Egyptian hieroglyphic script. From the Roman age through the medieval European history, new taxes on inheritance, property, and consumer goods were levied, and often played a role in war, either by funding them or provoking them. Other cradles of civilization, such as ancient China, also levied taxes under the authority of the strong centralized government. The Chinese Tiang and Song dynasties employed a methodical census record to trace their populace and impose the proper taxes on them. These funds and materials were then used to support armies, construct canals for transportations, and also for irrigation. The Mongol Empire that took control of much of Asia around 1200 instituted tax policy designed to influence large scale of production of certain goods like cotton. The comparison between zakat and tax system. Zakat is the religious obligation, while tax system is socio-political obligation. Next, the legislation of zakat is determined by Al-Quran and Hadith, while the tax system is determined by common law, which is the IRB or LHDN guidelines. Furthermore, zakat is subjected to only Muslims, while tax is subjected for all citizens. Next, the collection of zakat will be collected by the Islamic Council (PPZ), while the tax will be collected by IRB or LHDN. Lastly, zakat will be distributed to 8 asnaf, and tax will be used for development and routine expenses for the country.
My name is Nurul Hafizah binti Abdul Samad. My matric number is 1917728. So I would like to present about what types of tax. As we can refer from the slide, there are two types of tax, which is direct tax and indirect tax. Direct tax is a tax that cannot be levied or imposed on others. Direct tax is responsible to pay fall under an individual or organization, and it will be paid directly to the government. Meanwhile, indirect tax is a tax that can be levied to others. This tax is imposed on the entity or individual, and it will be paid for another person. Here is an example of direct tax, which is first, income tax, second, corporate tax. What is income tax? Income tax is a charge by the government to a business or individual income, and then the revenue will be used for fund services, to pay government obligations, and then to provide beneficial goods and services to the society. There is two types of income tax, which is personal income tax and business income tax. Personal income tax is a tax which is imposed on the individual income. Meanwhile, for the business income tax, it is a tax that imposed on the income of the business itself. Here from this slide, we can see the income tax rates between several countries. So we have choose Maldives and Denmark to compare with our income tax rates. Corporate tax. Corporate tax is a tax imposed on the corporate's profit. It is collected by the government as the sources of income in the economy of the country. And then this tax is imposed based on companies' operating earnings. On the slide, we can see that between these countries, Malaysia shows the highest corporate tax rate, which is 24% compared to Denmark and Maldives. Generally, the larger and more industrialized nations tend to have higher corporate income tax rates. So, the lower the corporate tax rate is, the better. Now we move to indirect tax, which is also known as consumption tax. There is two examples of indirect tax: sales tax and goods and services tax, which is GST or value added tax, VAT. Sales tax. It is imposed on the sales of goods and services. Sales tax is a tax that imposed on the percentage of price of goods sold, but it is levied on certain types of goods and services. Next, we move to goods and services tax, GST, or also known as value added tax, VAT, for other countries. This GST is imposed on most goods and services of domestic consumption purposes. Usually, this tax is already included in the price of goods and services and will be paid by the consumers. The portion of GST or VAT will be collected by the business and passed to the government. From the GST or VAT rates shown, Denmark was the highest percentage tax imposed on its goods and services, which is 25% compared to Malaysia and Maldives, which share the same percentage of 6%.
My name is Mohd Nizam bin Barom, matric number 2012625. Today, I would like to present about the composition of tax revenue for different countries. In this topic, we will discuss about why different countries have different tax revenues, the countries that pay higher tax revenues, and also the countries that pay lower tax revenues. The reason why countries pay different tax composition revenues is due to two things, which is the level of development of the country and also the efficiency of its government to collect tax revenue from its people. One of the countries that have higher tax revenues is Denmark. The Danish tax system is a progressive one, which means the higher your income, the more taxes you need to pay, but also if your income is lower, then you need to pay lower taxes. The Danish tax system consists of direct taxes and indirect taxes. The direct taxes in Denmark consist of personal income tax, state tax, property tax, church tax, and also corporate tax. For the personal income tax rate, people who earn from 0 to 56,500 crores, they need to pay about 27%, while people who earn more than that, they need to pay about 42%. While for the state tax rate, people who earn up to 46,200 and more, they need to pay about 12.16%, but people who earn more than 513,200 crores, they need to pay 27.16%. For the property tax rate, people who has a property up to 3.04 million, they need to pay about 1% of property tax, while more than that, they need to pay about 3% of property tax rate. The church tax imposed in Denmark is due to the majority of its people whose religion are Christians. The church tax rate is 0.4 to 1.3%, while the corporate tax rates paid by companies to the government is 25%. The indirect taxes in Denmark consist of three, which are VAT tax, which is also known as value-added tax, green tax, excise and custom duties. The VAT tax is about 25%, while the green tax is about 4%, and excise and custom duty is about 5 to 14%. The reason why Danes pay higher taxes because they believe in investing in the quality of life, as education and healthcare in Denmark are free, so they believe due to the freeness of their education and healthcare system, they need to pay higher taxes. Besides that, the higher living standard of people in Denmark, Denmark is known as one of the country who has a higher income per capita. One of a country that have lower tax revenue is Maldives. Maldives is basically a country that is reliant on its tourism sector for revenue. The taxes in Maldives consist of direct and indirect taxes. The direct taxes in Maldives are personal income tax, property tax, corporate tax, remittance tax, business profit tax. The personal income tax rate in Maldives ranges from 0 to 15%, while the property tax rate is about 10%. Corporate tax rate paid by businesses to the government is 6.18%. A remittance tax, which is paid by foreigners who are working in Maldives, when they need to send money back to their home country, they need to pay it about 3%. The business profit tax, which is paid by companies, partnerships, and other persons, is about 15%, while profit from sources outside Maldives is about 5%, and withholding tax is about 10%. The indirect taxes in Maldives consist of three also, which are goods and services tax rate, tourism goods and services tax rates, and also green tax rate. The goods and services tax rate is about 6%, while the tourism goods and services tax rate is about 12%, where it's basically charges on tourism goods and also services. The green tax rate in Maldives is imposed to tourist resorts, hotels, and vessels is about USD 6 per day, while tourist guest houses is about USD 3 per day. Maldivians and permanent resident holders are not required to pay green taxes, as basically they are the people who live there for so long, and they are also considered as citizens of Maldives. The reason why Maldivians pay lower taxes because it is due to their booming tourism industry. Maldives is very well known for its tourism industry and has a higher foreign visitors from year to year. Besides that, 90% of its tax revenues for its imposed for the import duties and tourism-related taxes. So that's the reason why usually Maldivians pay lower taxes, as the government earns most of its tax revenues from its tourism industry.
I'm Maratika Mitinazli. My metric number is 1916680. I will be presenting about the relevant issues on taxes. In this part, I will focus on the issues of the other forms of taxes. For example, inheritance tax, windfall tax, and capital gain tax. However, I will only focus on two kinds of taxes, which are inheritance tax and windfall tax. Firstly, estate and inheritance tax. These taxes are levied on individuals' property, especially after their death. Definitions: inheritance tax is a tax paid by someone who inherits property or money from a person who has died, for example, family or close relatives. Whereas estate tax is a tax paid by a state, for example, money or property of someone who has died. Next, countries which are imposed these taxes can be found in developed countries, for example, Japan, South Korea, France, the United States, and the United Kingdom. There are few issues related to these taxes. Firstly, some countries believe that these taxes are poor source of revenue and decided to eliminate this kind of taxes altogether. Next, poor economy policy. This is because these taxes fall almost entirely on capital stocks. The accumulated wealth make it richer, and this situation will discourage investment. Both taxes are complicated, especially for government to enforce it. Furthermore, these taxes encourage high net worth individuals to participate in inefficient economy. For example, they will decide either to do an estate planning or exit the nation altogether. In 2016, issue in the UK is the Jeremy Corbyn criticized the taxes exempt arrangements. This critique followed by the death of Gareth Grosvenor, the 6th Duke Westminster, whose significant at that lost interest. Due to unfair rate of taxes, critics claim that these taxes impacts more on standard living of the middle class rather than super rich class. Secondly, windfall tax. Windfall tax is a tax levied by the governments against certain industries, especially when economic conditions allow those industries to experience above average profits. This tax will impose on the industries which benefited the most from economic windfall or economic expansion, for example, commodity-based businesses. Next, countries which are imposing this tax. There are many countries which imposing this tax, including developed and developing countries, for example, the United States, the United Kingdom, China, and Thailand. Issues on windfall tax. In this part, I will focus on Malaysia. In January 2020, government imposed 3% of windfall tax to the palm oil producers whenever the palm oil prices went above 2,500 per ton. Next, the other issues of windfall tax in Malaysia. Due to COVID-19 outbreak, it can be seen that the glove company net profit has been soared. For example, Top Glove Corporation Berhad's net profit soared to 1.87 billion, whereas Supermax Corporation Berhad net profit soared to 789.5 million. As a result, government plans to impose windfall tax to the businesses which are related in this sector. This plan doesn't get full consensus from Parliament. For example, Finance Minister of Malaysia, Datuk Seri Tengku Zafrul Tengku Abdul Aziz, said that imposing this tax will send a wrong signal to the investors, especially for an open economy like Malaysia. He said that the investors will think twice before investing in our country. Next, the policies have to be for the long term, not for the short-term gains. If this situation happen in Malaysia, we can predict that our GDP rate will decrease significantly.
My name is Nur Fatihah binti Muhammad Mohd Nizam. My metric number is 2010800. In conclusion, tax is defined as a fee imposed by the local, regional, or national government to fund public expenditures. There are several objectives of why taxes are levied on individuals or corporations. Some of the objectives are to increase the growth of the economy, to influence demand level, and to discourage people from buying harmful goods because tax is imposed on harmful goods like cigarettes. There are two types of taxes, direct tax and indirect tax. Direct tax is tax that individual or corporation have to pay directly to the government, while indirect tax is a tax that can be levied on others. Denmark has the highest tax revenue, and Maldives has the lowest tax revenue among other countries in the world. The concept of tax fairness is defined as a tax system that is fair to everyone. The idea of what makes a fair tax may depend on individuals' income and wealth. Tax fairness is understood as what is more fair to the individual to what is more fair for a society. Most of tax authorities, like the government, try to balance the fairness between individuals and society. A tax system that is fair to the individual will let them keep most of their property, like the money they make or the wealth that they own. The concept of tax fairness also stated that the most deserving people will pay the least tax, though the term most deserving may not be clear. There are three tax systems that focus on tax fairness: regressive taxation, proportional taxation, and progressive taxation. Regressive taxation is a system that people with the least money pay the greatest tax burden. The example of this tax is a sales tax. People with low income need to pay the same amount of tax with people with higher income. Next, proportional tax is a tax that requires all taxpayers to pay nearly the same amount of tax. Progressive tax allows people with a lower income to pay the lowest amount of tax. The tax rate goes up along with the person's income. In Malaysia, personal income tax is a progressive tax.